Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Mettle, and I'm here today with Heather Dreves, Director of Funding for the Secured Investment Corporation. And today we're going to talk all things about one of my favorite wealth and income vehicles, private money lending. I did my first private money loan when I was 21 years old. I still have a decent amount of net worth out in private money notes. I love them. I've been burned by them. I've done very well by them. And so Heather's going to be helping us shortcut that path to not get burned, but still become wealthy by investing in notes. So we're excited to have her here. Heather's has been active in the private money space for over 17 years, which means she started when she was 12. And she's personally raised over $300 million in private money investment funds. She's definitely been around the block in this industry. And she's also a mother of two. She's an avid outdoorswoman, a CrossFit athlete, and a former college soccer star. I think we could put overachiever in there somewhere. But Heather, it's super cool to have you on the podcast and on the live stream. How are you today?
I'm doing great. Thank you for having me here. I'm super excited about this.
Probably not as excited as me. This is something that I really didn't know how to bring to our audience because it is such a non-traditional investment vehicle. It's something that I have dabbled in successfully and unsuccessfully for over 20 years, but I didn't know how to really educate people about it. So having you here today is perfect. Let's start out with just a little background so people can understand, where you came from. How did you get into private money lending? You at one point had your Series 63, so I assume you were in traditional investments at some point, but bring us up to speed of how you got here.
Yeah, absolutely. Well, I always find it interesting when people tell me their paths to what they're doing currently, because as I'm no different. Like most people start out on one path in college thinking they have this idea of what they're going to do, whether they go to college or not. And normally 20 years later, you're a lot of times doing something very different.
Totally.
I went to college to be a teacher. Needless to say, my kids can attest to it. I would have been a terrible teacher. I was not great with work. But found that I kind of had a niche for sales and had a friend that I had, previously worked in sales with. And when our youngest son had finally gotten into kindergarten, I decided I was going to go back into the workforce. I had stayed home with them and worked on a family business with my husband, and then decided it was my time. And funny enough, I had a friend in the private money industry, and he was encouraging me to come to work for him. I had no idea what private money was. I thought when you wanted to buy a piece of real estate, you went to your banker, you got a loan from the bank. And when you wanted to invest money, you called up your financial advisor and you did what he was telling you to do. So to make a really long story short, I went to work for him and kind of started as his assistant and quickly decided that my aspirations were much greater than being a loan officer's assistant, and kind of had this interest in the private money investment side of things. So I understood and learned that we could lend money to people that were active real estate investors that had a good deal, and I think that's kind of what it comes down to. Is it a good deal? Is there enough meat on the bones? Then there's typically a lender for that. And then I started getting really interested with the lenders. It's like, what do you mean? These people have this capital that they've preserved and saved up, and instead of putting it with a financial advisor, they're funding mortgage notes and they're putting monies in funds. And I'm starting to see these returns they're yielding, 8 to 12%. And these clients were all local. And it was funny because I, no joke, had lenders that would come in with a rolled up checkbook to buy a mortgage note from me. And they're always on vacation. And I'm like, how does this work? So I got my Series 63 because that company that I worked for, we sold fractional interest in notes. So at that time, you did have to have a securities license. And I was all in. I was like, absolutely, And so, that was kind of my path to the investor relations side of things. And, along the way, 17 years later, I'm still helping people accomplish their, financial goals and freedom financially, and have become an active real estate investor, and hopefully have educated my kids that, you may have a day-to-day 8-to-5 job, but there's always opportunity to do other things and create wealth for yourself and your family. So I'm just really passionate about about helping people get financial freedom. Just for clarification, I'm not a financial advisor, but I see the way that these people live, and they're not even dipping into their principal. They're living off of their earnings. They're taking vacations with their families. And so that's what gets me up in the morning.
That was awesome. You touched on something that is one of my core value philosophies in investing, which is, I mentioned a little bit about, I called it the non-traditional lending space and or investment space. The traditional investing space is, you invest in your 401k, you invest in index funds, you essentially build up a nest egg throughout your life. And then when you retire, you hope that you die before you burn through that nest egg, right? That's kind of the traditional game. The non-traditional investment game is usually referring to something like private money notes. Maybe you invest in a business that spins off cash flow. You own real estate that spins off cash flow. And that's a little bit of a different game. See, with that game, what we're doing is we're controlling assets that spin off positive cash flow. And then when we go into retirement, or when you just don't want to go to work for 90 days and take a sabbatical, you don't have to cannibalize or sell off your nest egg. You simply live off the cash flow. And so that game, to me, just from like an energetic standpoint, is a lot more inspiring, right? Instead of building something and then cannibalizing it and hope I die before it's gone, I'm building something that is going to fund my lifestyle for as long as I live. And then my kids, unless they really screw up, they get to inherit that nest egg, and then they get to take not only that money, but they get to take the education and the knowledge that I'll pass on to them to continue on. So I'm glad you hit on that. I think that's really important from a philosophical standpoint.
Yeah, absolutely.
Cool. So what in the heck is a private money mortgage note? Let's start there.
I think that's a great question, because I have people that will call in and say, we want to buy a note. And then once we have the conversation, they're like, oh, that's not even what I thought it was, right? So I think that's a great place to start. A private money mortgage note is, and I'll have some people say, I only want to buy a mortgage, I don't want to buy a note, or I want to buy a note, but I don't want to buy a mortgage. Just for clarification, you are buying both. If you are buying a note, that is a borrower's promise to repay a loan. So that's going to identify what the rate is, how much the principal balance is, when they have to pay, and when the loan matures. And then other things that are within that promissory note are going to be, things that happen if they default, if they don't make their payments, if they don't keep their taxes current, if they don't keep it insured. There are events of default that can accelerate interest payments. So you're buying a promise to repay a note, and then your mortgage or your deed of trust, so it depends on the state that you're lending or buying a note in, that is your security instrument. And so that is the lien that is recorded against that piece of real estate. So that is your asset, and that is identifying that you are now the bank. And so you are buying a lien against a piece of property, and you are going to be repaid one of several different ways. Our mortgage notes specifically require our borrowers to make interest payments every single month. So they're paying interest only, which would then be sent on to the mortgage note buyer. And then they pay the principal off at the time of payoff. So when the loan matures, or if they pay it off early, ours do have the ability to pay off early. So you're buying a lien, and the way that you're being repaid is through monthly payments most of the time. It doesn't mean that every mortgage note has monthly payments. And then your principal is typically paid off at the time of payoff or at the maturity of the loan. So I tell people, you're the bank. And what is securing your money is the lien against that property. That gives you the legal ability, in the event that they default, according to the promissory note, if they don't do all the things that they've agreed to, you now have the legal right to go foreclose on the property. And that is what is protecting your investment.
Yeah, exactly. And I believe it's one of the safest, if done right, with the correct knowledge. It's one of the safest investments on God's green earth, because you're afforded the same protection as the banks that make mortgages. And these have been done hundreds of millions of times, right? You have, as a lender, was secured by a note and a trust deed, you have the same protections that Wells Fargo, Bank of America, or any other bank would have. So trust me, if they're lending trillions of dollars through this vehicle, it's a safe investment as long as you do it with the right knowledge and you do it with the right, note and trust deed to protect yourself.
Absolutely.
So Heather, I mean, this is a changing real estate environment. And so as somebody who is directing money and investing money into notes secured by real estate, you must be watching what's going on in the real estate market. So what are you seeing as it relates to challenges, opportunities, trends, changes? What has your attention in the real estate market in 2023?
That is an interesting question, and it changes on a daily, right?
That's right.
As a director of funding and a fund manager, this is something that me and my team look at every day and it's interesting. I just had a meeting with my servicing team. We go over all of our assets on a weekly basis. And they said, but you said this last week. It's like, I know. And now this week, this is what we're saying, because this market is changing so quick. One of the things that I think would be important to explain is when we lend money, so when we're creating these mortgages, we are lending money to people, and we only lend money to real estate investors. So we are not going to lend money to your Uncle Joe who doesn't have the best credit and wants to live in the house. When you start lending on owner occupied, just be mindful that there are a lot of laws and what they call usury laws that you have to be very careful about. You can't charge them more than certain amounts of interest. And this is typically state specific, but we lend only to real estate investors. So our typical borrower is going to be somebody that is buying a distressed asset, and they are going to do what we call a value add. So they're going to rehab it and increase the value of it. And their exit strategies can be multiple different things. It could be that they're going to what we call fix and flip. They could be rehabbing it to put a tenant in and create a cash flowing property. And I think that is one of the biggest changes we've seen lately. We all know what's going on with the market. Interest rates have gone up. Prices are starting to come down, and it is really dependent upon the specific location of that property as far as the decline in values. Right. And we lend nationwide, so we lend all over. But one of the biggest changes I've seen, and they joke that in a recession and a downturn market, a real estate investor typically turns into a landlord, because as prices go up and sales are going down, rents are also going up. And so I've seen typically our borrowers in the past have fixed and flipped. It was 12 months ago, just about anybody could buy a property and make money off fixing and flipping it. That is not the case right now. And I think that's actually weeded out a lot of your less strong borrowers, right? Now you have your very sophisticated borrowers, because in a downturn, real estate investors love this, right? Because prices are down, there's more opportunity, there's less buyers. But a lot of our borrowers have changed their exit strategy. So many of them now, instead of fixing and flipping, are starting to buy and hold. So they're buying distressed properties, rehabbing them, getting tenants in them, because the cash flow is so good on them right now. And typically what they're going to do is they're going to ride this out, and when interest rates start to come back down, people are going to start buying, and prices, historically will start to go back up. That is one of the biggest changes. We've also adjusted a lot of our underwriting criteria. We want to make sure that in this market, these are very sophisticated borrowers that have experience, because I will tell you, we have borrowers right now that 10 months ago were going to fix and flip a property, and now they're realizing the value is not quite what they thought it would be. They haven't got the project done. Those are the ones that we're trying to coach and get out of this. We're telling them, get a tenant in it, get it cash flowing so you can at least service the debt. So I would say that, biggest changes is exit strategies and borrowers has changed a lot. And then also, from our perspective internally, we have, really tightened up guidelines. We're looking more conservatively at a lot of these deals, because it's a different market than it was even 6 months ago.
Yes.
And there's a lot less room for error. So we want to make sure that we're lending money to people that have multiple exit strategies and have the financial wherewithal to get out of these deals, because we're a short-term lender. Our average loan term is 12 months. So we want to make sure that they can exit these loans and have some options.
Well, it's funny, I got started down the path of being a landlord because I was a bad real estate investor. What I mean by that was I was that fix and flipper that you were describing, who misgauged the market, ended up realizing I was either going to take a loss on my first real estate investment property. Thankfully, I was partnered with my mom, who had a lot more experience than I did. And she said, well, why don't we just rent it out and weather the storm? And I was like, I didn't know you could do that. And so we rented the property out. I think we had a whopping $27 a month in cash flow. But 22 years later, property's free and clear. It rents out for $1,500 a month. And it gave us that entryway into saying, okay, we're not good flippers. The market's about to crash every time we buy a property. So we just need to start gauging off of cash flow. So hopefully there's a blessing in disguise here for some of those investors that, as you said, the rental market's still very strong. They can turn into cash flow. And in the long term, I think they're going to make a lot more money that way holding properties anyway.
Oh, yeah. Yeah. Cash flow is king.
Why do real estate investors come to you for funding versus going to their bank?
I have people ask that, and I especially have investors that are looking at notes saying, you mean I can get 10% on this? This borrower must be a terrible borrower. Why would they pay that interest rate? That is not the case. We are going to be less cumbersome than a bank. One of the biggest things with banks is they can't see potential, right? They aren't going to look at a distressed property and say, hey, you're buying that for $50,000. You're going to put 30 grand into it and potentially maybe it's worth 150. They're going to base it off what you're buying it for. Right. So unless you're a individual or an investment group that has the capital to front the rehab, maybe they're going to give you purchase money, but they're more likely than not going to not give you the rehab funds. So instead of an investor tying up all their capital and only being able to do one deal every 6 months because they're fronting all the cash for it, they could potentially come to us. They can get purchase price money. They can get rehab money. Most of the time we want to see them bring in some, what I call skin in the game, so they're going to have to bring a little bit of cash. But, based off of lending or borrowing from us, they could do 3 or 4 deals in the same time frame, compared to just doing one deal using their own cash. So, we have very clearly defined guidelines. It's not, like we don't look at the borrower. We want to make sure, and it's not really, people are like, do you have a minimum credit score? It's like, no, but I want to make sure that I'm putting, Josh in a good position that he can be successful and he's going to get out of this deal and he's going to make money. It's not just about our investors and the return we can get them. We want our borrowers being successful because we want them to borrow from us over and over. And so to answer your question, a lot of our really good repeat clients, they understand our process. They know exactly what we want, what we require, what are the, we require them to have certain amount of money in their reserve accounts. We pull credit, we pull background, but we also really focus on the asset, right? Because at the end of the day, the risk in buying notes, and I tell people this all the time, you better be comfortable with that property. That is what is backing your money. If that borrower doesn't make their payments, which is not that common, but it is the risk, you're going to have to take that property back, right? So when we're underwriting, we are looking at that asset, trying to make sure that we are well secured, we're well positioned if we have to foreclose and take it back, and we can get out whole and make some money above and beyond there. So, those are all the things that we look at, from an underwriting perspective. And I think, people come to us because they understand our process. We're not going to be as restrictive as a bank is. Yep. And it's a numbers game, right? This. Run the numbers. If your cost of capital is 10% and it doesn't pencil out, you're probably paying too much for the property. Right. And you need to take into consideration, what you're paying for it, what the rehab budget is, what it's going to cost to service the debt for the time that you're using private money, taxes, insurance, and it's a numbers game. If the numbers work, then it's a cost of doing business. It's just in their formula.
Yeah. They can count on you. They've got a system with you. Yeah. I was thinking every investment has investment risk. Right. But the difference is, if you put your money into AMC or one of the other meme stocks or something like that, when it goes from 100 to 5, you took a 95% loss. If they go bankrupt, you have nothing. You are completely naked, man. And with a note, if they don't perform, you get to take the property back. You can rent the property out. You can do the renovation. You can fix it up. You have options. And as I've learned, time cures all in real estate. So if you can hold on, if you can do a value add and improve it and rent it out and create just enough money to debt service, you can solve a lot of problems in the real estate game. So you have multiple exit strategies where if I just am a stock owner, my only exit strategy that is really successful is that the price of the stock goes up. But that's it. If that doesn't happen, then, it wasn't a good investment.
Right. And, the other thing I don't think that people understand about private money is most private money lenders are going to lend with some equity in the deal, right? Like we don't lend more than 70% of the value.
Sure,
so
right.
There's a potential 30% upside. And I guess the point of bringing that up is most borrowers don't just walk away from these deals, right? They've got their cash into it. They've got their time into it. They've got equity into it. What I find often is if they are having challenges and we service all of our own notes. So we service about 500 notes. So we know exactly what's going on with, like I said, we meet every week. Like I know exactly who's not paying, who's paid. But the point of that is we can help those people, right? Like the reality is for us as an organization, we're not lending because we want to take them back, right? If we're going to acquire properties, we'll go buy our own. But if we can identify that, John's having some issues, his contractor took off on him, we can at least help him and coach them and get them through it. What I tend to see that happens is if they get into a little bit of trouble, they're going to get a notice from us at 45 days late. That gets their attention real quick. And they're usually calling and we're advising them. Maybe it's a matter of we had one yesterday. This gal's been so far over her head. She's been trying to rehab it for 12 months. We literally told her, cut your losses, throw that thing on the market and get rid of it and chalk this up to experience. You're not going to get money, but you're not going to get foreclosed on, and we're not going to come after you for a deficiency, So sometimes, and you probably know this, as many deals as you and your mom have done, they're not all winners, right?
Nope.
We'd all love to say that they are, but the reality is, I can remember the first house my husband and I rehabbed. It took us a year. We thought we were like Chip and Joanna. So we were doing everything ourselves, sucked, and we didn't make any money. But moving forward, we never did it the same way again. So, most of the time, like our foreclosure rate's under 2%. It's very low because a lot of the times they're going to be calling in, hey, I'm just in over my head. Let's figure something out. But again, like you said, the security is you're the bank. Now you have the ability to take that asset back. That is what is securing your money, which is much different than a stock investment. And I believe one of the safest things you could be doing, but you need to understand these are the things that can happen and you need to make sure you're getting in good deals. I have horror stories from people that called us to buy a note and got greedy and found some guy at an REI club that offered to pay him 12%, never got anything recorded against the property, quit paying him. So I word to the wise, just make sure you're doing your due diligence.
Absolutely. 100%. Either work with a professional group like yours, hire an attorney, make sure you have really good advice. So Heather, one of the we do a lot of looking into what the most popular Google search terms are.
Mm-hmm.
And right now, 3 of the hottest are recession, housing crash, and inflation. So, we talked a little bit about kind of the housing market and the things that you're looking for. Let's talk a little bit about inflation, because I find that as potentially one of the most powerful forces in all of money and economics, people know a ridiculously inadequate amount about inflation. So I'm just curious, how do you think about inflation? How do you think about positioning your assets to survive times of inflation and potentially thrive throughout those times? And how does it impact your personal investment strategy?
Yeah. I think that's a great topic. And, we talk a lot about it here just within our organization and, at home with my family, because we're all involved in our assets. And, obviously the dollar's worth less right now, right? Everything is increased in price, to food, to gas, to the cost of living, right? Yep. And so, one of the things that we've seen is, although rents are starting to increase, people can afford less, and we talked about this in our asset meeting yesterday, because we have a couple rentals that we're trying to rent. And, based off of rental markets, we put them out there for, a fairly high amount. But we found that quite a few of the applicants just can't afford it, and so I think that's something to be mindful of if you're holding real estate, is affected by inflation. I haven't really been affected by it personally because our renters are really good, knock on wood. We've had really good success with that. But I don't feel like, although inflation is a big topic right now, I don't feel like it's really affected us here at Secured Investment Corp. Like I said, we deal with really sophisticated borrowers that are pretty excited about some of the opportunities. I do think because of the inflation, and there are people selling their houses because they are needing to downsize and can't afford, what they're currently in. That has created some opportunity for us from a buy perspective. We've gotten some smoking deals lately, and you hate to say that because someone had to sell it because they can't afford it. But as a real estate investor, that I feel like has created more opportunity for us. From the investment side of things, we have more people looking to invest dollars to make up because of the inflationary time. They're looking at, okay, I'm working an 8 to 5. I got to create some other cash flow. So that again has also, has become an opportunity for our company. I feel like lately we've had more people inquiring about, like you said, not how to break into their nest egg to afford to live because of the inflation. They're wondering how they can get their money working for them to, afford some of these increased inflationary prices. So I don't look at it as a bad thing right now. It has been some opportunity for our company, but it's always something on our radar for sure.
Yeah, we do a presentation around real estate investments, and it's called investing in real estate to secure a stable retirement or successful retirement or something like that. And one of the things that we talk about in that, we show a slide that says, if you make $5,000 a month, or if that's the kind of income you want to have in retirement, then that $5,000 equates to a certain type of lifestyle. But in 20 years, it's not going to take $5,000 a month to equal what you gauge as a $5,000 a month lifestyle. And we show a chart with compound interest at 2, 3, 4%, but it's actually going to take $9,000 or $12,000 or $15,000 a month in income, depending on how many years and what the inflation rate you want to estimate. And that's one of the things that I think people are miscalculating right now, right? They're saying, hey, all I needed in retirement is $5,000 because I can live on that right now. My house can be paid off. I'm going to be comfortable. Yeah, but $5,000 in lifestyle today in 20 years is going to give you $1,700 worth of lifestyle, right? So we have to account for that inflation. And so what's the lesson there? We better be investing more, and we better be investing early, and we better be investing our dollars, I call that our life energy, into something that is going to grow faster than the rate of inflation. So if you got your money in a savings account and it's making 2 or 3%, and you're like, well, you're actually losing 5% of the value of that money because inflation's at 8%. So I just think that people need to look at inflation as eroding their lifestyle. And that means they're going to need more money to have the same amount of lifestyle.
Right. No, I think those are really good points.
Have you raised your rates that you lend to people based on the inflation that's happening, or have they stayed pretty much the same?
They have actually stayed the same. So one of the things that's unique about us as a private lender is most private lenders get their capital from Wall Street, right? They're lending money through their lending company, but they're originating those loans off a line of credit from Wall Street. I came on board 11 years ago, and this is something that I'm pretty proud of, is we've never done that. We always said, we don't want to be at Wall Street's mercy because they can shut those lines of credit off at any minute.
Absolutely.
Like COVID is a perfect example of that. I don't know if you were in private money then and was doing, some borrowing or lending, but literally overnight, I remember, because we used to broker a few deals, they called and said, we aren't lending anymore. And we have always said, we will eat what we kill. The capital that we raise is the capital that we will deploy. And so when when rates started to go up, we talked a lot about it. The one thing we didn't want to do, and I think this is where private lenders kind of miss the boat is, they'll start to get a little greedy, right? Well, rates are going up. We're going to charge 12%. Well, you know what you attract charging those kind of rates are the poor borrowers.
Interesting.
And so we really wanted to continue lending money to our stronger borrowers. So we kept our rates the same. We have not increased them. We actually just talked about it in a meeting yesterday, and our VP at Kogo was like, no, we're not raising rates because we want those better borrowers, so you start raising rates and the sophisticated ones are going to start shopping. That's the smart thing to do. It's what I would do. And so we have left them the same. It's a conversation we have from time to time. But as of now, we are not raising our rates, which is hard because I get a lot of my investors calling, well, rates are going up. Why aren't I getting higher rates on the notes I'm buying? And it's like, hey, if you want a guy that's going to pay 14%, I can get you a guy, but you're not going to like him. He's going to have no experience, bad credit.
Right.
So,
risk reward trade-off.
It is. And that's what I tell people. And I think that's one of the things when people are buying notes, they get wooed by these rates. And, the guy that said he could pay him 12%, it's like, well, how qualified? And I'm not saying they aren't all qualified, but I'd much rather lend money to someone at 9 or 10 that was qualified, has a track record, has proven history.
Yes.
The guy that's never done it before, and I might get 12%. That's if he makes his payments. So we're kind of holding strong and steady to that. We don't need to raise our rates. We have plenty of capital. We sell a lot of our notes. Our model is to originate through our funds, and then we sell the paper off. So we have two different types of investors. We have our active investors that like you, that like notes, and we sell a lot of our notes. And then we have some clients that say, well, I like notes, but what if they don't pay? I don't want to deal with that. And so the nice thing about what we offer is they can put their money in the fund, which is really just a pool of notes if they're not quite as risk adverse and they just want something extremely passive that they know they're going to get regular payments on. They typically will gravitate more towards the fund rather than the notes. So it just depends on the appetite of the investor.
Got it. And is the fund securitized by any real property, or what is it securitized by?
So the fund is what we would consider a debt and an acquisition fund. So what we do is 75% of the balance of the fund, we lend out in mortgage notes. So those notes that we originate, those are the assets of the fund until we sell them. Once we sell them off, then if Josh buys that note from me, he's now the lien holder and the note owner, and we recoup the capital for the fund. So we turn that capital over and over. And then the 25% of the fund balance, we acquire properties only in our local market. So Coeur d'Alene, Idaho, and Spokane, we have an acquisition team. We will buy real estate. We have a contracting crew. If we're going to rehab it, they'll go in, they'll rehab it. We have a property management division if we're going to hold it. And then if we're going to sell it, we're actually a Keller Williams agent will sell it. So if that money's deployed through an acquisition, the fund owns those. We don't own any of it. We're just managing it all. So again, it is all secured by either debt or the acquisition of real estate.
I love that you're actually doing as a business what you're lending on, right? I mean, what an intricate knowledge of the market and the risks and where people get hung up. That's really cool.
Yeah, we practice what we preach, honestly. I mean, we are also an education company. And so I believe that we have a great system, and it's taken us a long time to kind of master it. It's kind of learn as you go, but we do everything internally. We haven't had a ton of success outsourcing things. And so I swear every year we joke with our CEO, we're like, we're not opening another company.
I like this guy. I got to meet this guy.
Last year we became a property management company. So we're like, we're done. No more companies right now.
Oh, it's tough to bridle those entrepreneurs, isn't it?
Oh, yeah. We have lots of guardrails up for them.
I get it. All right. So let's play a game, Heather. Let's just imagine that I just inherited $1 million from Grandma Ruth, Grandpa Bob, and all that money just hit my checking and savings account. I am aware that inflation is ripping away at 7% or so, and I want to do something with that money. So my options are, I can go the traditional investment route. I can stick that money in Wealthfront or give it to an advisor, and I can own index funds that diversify across stocks of companies all over the country, world, you name it. That's one option. Another option is I can go out and I can buy real estate. I can become a landlord, or I can hire a management company. I can take the rent, the positive rent off those properties. Another option may be I partner with somebody like you. I buy some notes. I take your guidance. Why would I invest in a note rather than procure my own real estate or go put that money into index funds?
Yeah, I think that's a really good question. And I actually get these calls every day, and not only people that inherit money. I mean, we deal with a lot of high net worth dentists and doctors and chiropractors and physical therapists, and they'll sell their practice and they're flush with cash. And like you mentioned, they don't want to cut into their nest egg. They want their money working for them. One of the things with and first, the conversation I would have with them is, how active do you want to be? One of the downsides to notes, and this is funny that people say this, is I hate when I get paid off. It's like, okay, you're mad that they paid you off. Like, that's the whole goal. But, their opinion is, I want this constant cash flow, right?
Yeah.
And so the conversation I would have first is, what are they trying to accomplish? And I tell all of our clients this, like, sit down and think about it. Are you looking for cash flow? Are you trying to replace income or, live off the cash flow and not break into your nest egg? Or are you more growth minded? Some of our younger clientele, they're working, they're professionals, they don't need the cash flow, but obviously they want to grow those accounts, because we have opportunities for that where you don't have to actually take your earnings, you can reinvest them. So that would be the first thing I would ask them is, if you do want cash flow and you don't want your money tied up quite as long, the notes are a great option. And I think the thing about us is we originate these notes. So we're not just selling everybody's notes. We're not a broker. We're not a middleman. These are notes that we internally underwrite. We service them for them. We are along for the ride. We keep an interest strip off those notes, meaning if we're charging that borrower 12%, I'm going to sell it to Josh at 10%, but he is now the owner of that note. But we have a vested interest. Like, we need that note performing to be profitable. But again, having that conversation, these are the downsides to notes. You might get paid off in 3 months. Good news, we have lots of notes. We can redeploy your capital. You might have to foreclose on someone, so if I start to get some hesitation with that, then the obvious, other option, the fund, right? You can still reap the benefits. You're still getting the same yields. Our fund has historically paid out 10 to 11% for 10 years.
Wow.
It is very easy. They can park 50 grand. That's the minimum. And they're getting double-digit returns on their capital. The other nice thing about the fund is if they are growth minded, meaning they don't need the monthly or quarterly cash flow, they can set that account to just reinvest their earnings. So now they're compounding their earnings.
Cool.
We deal with tons of clients that use self-directed IRAs, self-directed 401ks. If you have any of those accounts, they charge a lot of money for dollars going back and forth. That's very powerful with the fund because now they just reinvest their earnings. At the end of the year, we let Quest Trust know this is Josh's account value, and they adjust his account accordingly. So, again, the first conversation is, what are they trying to accomplish? How risk adverse are they? And I tell people also with mortgage notes, decide what you're looking for. Is it a rate you're after? Some people are very specific about location. I have a lot of clients that say, I only lend in my local market because if I have to take that back, I can go touch it, see it, feel it. So really just identifying with the client what they're trying to accomplish typically dictates the way that conversation goes. If, again, it's a very reserved client that's like, I would never foreclose on someone, I'm not even going to bother with notes because that is just outside of their appetite. But they can still get the same benefits of notes in a fund environment where they're in with a pool of other investors and hundreds of notes. The other thing is, if they want constant cash flow and they're trying to, replace income, if that note stops paying, they are not getting paid monthly, right? If they go into the fund, their 50 grand could be spread out over hundreds of notes. You're not going to see that fluctuation if there's a defaulted note not paying. And we handle everything. But again, I have very aggressive, very, active investors that like the thrill of a note. They like to dig into the file. And it's funny. I've got a guy that's 90 years old. He loves notes. And I'm like, Ron, put your money in the fund. You're too old to have this headache. He's like, I like it. He just likes looking at the deals. So
I love it.
it's just really, it's funny how everybody is very different. But like I said, I always tell them, what are you trying to accomplish? Write 4 or 5 things down. Otherwise, they get analysis paralysis. Though I want to look at 10 notes. It's like, no, you don't. You're never going to make a decision. You can't, there's no possible way unless you can weed things out. If you only lend in Park City, Utah, then you're only going to look at deals there. So I don't know that there's a cookie cutter answer to your question, but I think that we can help people accomplish cash flow. We have a growth model. And the other thing I'm really proud about, we don't only just cater to accredited investors. We actually have the same fund for unaccredited investors. So we have that same model, the 75% debt, 25% acquisition fund, as what they call a Regulation A+ fund. And the minimum investment is $1,000. So for our younger generation, my son just got a job as a full-time fireman. He's 24 years old, making ungodly money. And I'm like, set this stuff up. Like, you start this now. Well, don't you have to be high net worth? No, you can start now, get a Roth IRA, get this going. So
Good job, Mom.
we can just about accommodate anybody. And I love that, I don't know how much you know about those kind of funds. They're not easy to get, and they're expensive to open. You have to go through the Securities and Exchange scrutiny, but we felt a passion that everybody should be able to create wealth and financial freedom for themselves.
I love it. We're aligned around that, my friend. So just so everybody knows, an accredited investor, and Heather, I kind of know this, so help me out. I believe you have to have earnings of proven income of $250,000 for the last 2 years, or prove a net worth in excess of $1 million. Is that right?
That is correct. And the $1 million in assets has to exclude your primary residence.
Excluding
so
the primary.
Cannot include that.
So there's some types of funds out there that you have to be by law, a accredited investor, or you can't have access to it. And you're saying that you've created vehicles for both. Somebody who's just getting started can get started, and then they could move into those other funds down the road.
Yes, absolutely.
Got it. Very good. Cool. Well, that's kind of an interesting segue into one of the last questions that I had for you. The Bernie Madoffs of the world, most recently is the Sam Bankman-Fried, I'm maybe saying his name wrong, at the FTX crypto bankruptcy.
Oh, yeah.
Everywhere in the news. I personally worked with a couple of dentists that, as you said, they got out of school late. They came out into practice with a lot of debt. They started their own practice, which means they were investing into their business rather than taking W-2 paychecks. And they got so late in their life that they felt like they had to hit a home run, right? Like just getting on base isn't going to work for them. And they stretched into investments that weren't protected. They were lured in by 24% returns. And at the age of 50, I know a couple of these dentists, unfortunately, they literally lost their entire life savings. So since this is in the ether right now, this thing around the FTX bankruptcy, how do people protect themselves around that thing? I mean, I think some people go to Wall Street because they see Morgan Stanley and they have faith, they have trust. But how does somebody protect themselves in the world of non-traditional investments?
Yeah, I love this topic, and I've done webinars with other people in this industry. And I really think it boils down to knowing who you're doing business with, understand who that operator is. So we are an operator. We manage funds, we sell mortgage notes. And I can't stress it enough. Do your due diligence. Most of these funds are regulated by the SEC, which is very similar to stock investments. Mm-hmm. And so, there's some steps to take. Make sure they're in good standing with the SEC. Do a search on them. It's not uncommon to ask for audited financials. So one of the things with our funds is one fund is required to have audited financials, which means a third party accounting firm comes in and they make sure that if our fund says we do these things, we are only doing those things.
Got it.
They're going to audit our bank accounts. They're going to make sure that if we say our guidelines are XYZ for a note that we're originating, that we are following those guidelines. So one of our funds is required to have that done. The other is not, but as an organization and as an operator, we do it for both of them. And you should ask for audited financials. Do you guys audit your financials? And it's not to say that if they don't, that's a bad thing, but those are one of the first qualifying questions I would start to ask. Ask for references. I have people ask all the time, do you have, current and even previous clients that have done business with you? I have a guy that got into business with some guys out of Utah and, got a little greedy and he's in big trouble. They are probably going down and he didn't do his due diligence. And so know who you're doing business with, and ask for those things. And the other thing I tell people is ask questions so that you can set your expectations. Like, when are my earnings paid out? What kind of reporting do you guys do? How transparent is that operator with you, especially in a fund environment? There are lots of dollars flowing in and out of a fund, right? You want to make sure that, they're being very transparent with you. So what kind of reporting do they do? When can you expect that? When are you going to get your end of the year tax information? That's another thing with funds, K1s. Real estate funds are notorious for sending those out late because a lot of them are what are called syndications, where they're buying an apartment complex or they're buying a storage unit. And for whatever reason, they are notorious for getting K1s out late. If that's a big, hot button for you, then you might think otherwise, but ask that question. And know the people you're doing business with. It's shocking to me how trusting people are just over a phone call. It's like, I'm going to get you some information. Here's the things you need to ask. Here's what you need to do. Search them online. Most of the time, if they're not good fund operators and they're bad operators, you're going to find information on the internet. But, really do your due diligence, because I get calls all day, every day. Like, you told me not to do this and I did it anyways. And now help me get out of this mess. And it's not to say that, every fund is perfect and they don't have their challenges, but are they being transparent with their clients?
Yeah.
This is real estate. That is the risk going into this. And so transparency is a big one. But yeah, I know clients that did the FTX investment and it's like, I don't know what to, to tell you. But again, like you mentioned it, I feel like real estate, at least you have a physical asset.
For sure.
Like, that borrower might default. That project might not go as planned. It might not be as profitable, but you still have something backing your investment. You've
got options.
It's a lien, piece of real estate.
Yeah. I'll give you one more that I suggest, and that is pay attention to your gut.
Mm-hmm.
People sometimes when they make investments, they get excited, like a kid going to prom. And if you're feeling that overwhelming excitement, that's an indicator that your analytical skills might be blinded by the emotion or the excitement. And just keep your radar up. If there's these little things that most of the people, it's interesting, I've talked to that have made bad investments, in hindsight, they say, you know what? I knew there was something wrong with this, but I was so excited about the potential upside that I let the greed overcome my natural energetic instinct that I didn't trust that person for some reason. I couldn't put my finger on it.
Yeah.
So I would just say, be aware of your emotions. And if you're overly excited, that means you need a timeout, right? There's a reason why car dealerships put you in the car. It's because it gets your emotions going. And if you leave, you don't feel that same way, and you can make a totally different decision. Same thing with investments. And sit with yourself and just think through what's my gut telling me here, right? So you gave all the right analytical answers. I wanted to give one a little more energetic because I just noticed people have said that to me many times.
No, I think that's valid. And the other thing I talk, like you mentioned, the guy that inherits $1 million. Diversify. Don't put your eggs in one basket. I mean, that's another common story. Well, I just, and I think they get emotional about it and excited about it, but I would never encourage someone to put all their eggs with us. Like, you should diversify. And
great call.
We're pretty involved with a group of dentists that are in these masterminds, and they talk about quadrants too, as far as investments go,
Love that.
they basically have 4 quadrants, and, one of them's cash flow, one of them's growth, right? And so if you identify what those 4 are for you, then you can start to research and talk to operators like us and, start to make decisions. And I think that also helps diversification of your portfolio. So
it's a great point. Investments don't have to be binary, meaning on or off, all or none, right? Almost always investments are better when we go, I'm going to do a third here, and I'm just going to hold on to this third and see how the market works. And that one's really liquid. So I love that idea of getting ourselves out of that thought process that investment decisions have to be binary. I'm either in or I'm out. Not necessarily. You can just be kind of in, and you can be kind of out, and you can learn, and then you can decide if you want to be all the way in.
Yeah, absolutely.
Cool. Well, I think that was a great way to wrap this thing. We went like all around the investment world. That was a ton of fun for me. I hope you enjoyed it. I know people are going to want to know more about you. How do they get a hold of you? If they're interested in Secured Investment Corporation, where do they go?
They go to our website at Secured Investment Corp. So it's not plural, Secured Investment Corp. And they can actually find information about our notes. All of our notes are actually on the website that we have for sale. They can get more information about both our accredited investor fund and the other fund that is for anybody. It's open to the general public. And they can actually ask for more information, and they can schedule an appointment with me and my team. I've got 3 other individuals, to include myself, that work with our clients. And, we're passionate about what we do. We love to educate people. We don't, like I said, give financial advice, but we can definitely educate you about notes, about funds, and get you the information that a client would need to start their due diligence. And, just go to our website, and we'd love to talk more with you about it.
Great. Heather, thanks. Absolute pleasure. Look forward to having you and maybe your real estate education arm back at a future date. Okay. And thanks for joining the podcast today.
Yeah, thank you for having me.